folks. A 10-year real yield, ready, 2.17. That gave pause to Mark Howard. Thrilled he could join us this morning off of an important BNP Paribas conference here. He's the managing director of BNP Paribas. What was the level of global fear at the conference? Not Target, not what's Apple going to do, but that correlated bond market angst that you saw at your BNP Paribas conference.
Well, thank you, Tom and Paul. Yeah, you're absolutely right. You mentioned the Japanese long bond. That was, that doesn't come up all that often. That was front and center. People were saying, hey, there's a canary.
Right.
Just like what we're seeing in the U.S. long bond.
Thrilled you're here. Explain to mere mortals listening on radio, watching on YouTube today, thank you so much. Explain to them why adults in the game follow the 20-year Japanese.
Well, it is obviously the yen and Japanese assets have been viewed as a safe haven with the change in the outlook for the U.S. dollar and its status as a safe haven. And so when you see a backup and you see risk aversion there, that harkens to something more systemic potentially.
Paul, can we mention here that if yield goes up, that means price goes down?
I think I'm with you on that one.
Can we go home now?
Exactly. Hey, Mark, we've seen a rebound to a pretty large extent of the U.S. equity markets here. People kind of taking on a little bit more risk here after that uncertainty of the Liberation Day. Not for the dollar, though. The dollar's kind of sitting down and it's near its low here, recent low. What does that tell you?
Well, I think it's an interesting dichotomy because the equity market, the credit markets, what we call the risk markets, have had a nice rally, as you say, since the bottom in April. But the pure barometers of risk, currencies and rates, have been showing a different signal. And I think that's largely related to the big, beautiful bill and the potential for very large deficits well into the future. And that's disconcerting.
I have trouble with the naming of any major fiscal package, whatever the marketing is or that. This is a ginormous fiscal package of the United States. I read carefully 3 summaries this morning. Had nothing to do. The Red Sox. People got thrown out of the game. I was upset. So I read 3 budget analysis. Am I right? It's grim, whatever happens?
Well, Tom, unfortunately, we don't have full granularity, right? It's still working through
the representatives don't know what they're got.
Yeah, so it's hard to make a definitive call. But what I can say is at our conference yesterday, where we had Janet Yellen, we had Ray Dalio on Bloomberg streaming with Shanali, we had Gary Cohn, some really thoughtful insiders who understand the process, and they're all saying that this bill is a lot of stimulus. It's a little more front-loaded than some other stimulus packages. That's got the equity community enthusiastic, but the cost of all this stimulus at a time when the labor market is getting tighter, at a time when tariffs are starting to bite with inflation, is not good for rates.
Paul, you nailed the dollar perfectly. We're at support. We're within the range. Mm-hmm. Paul, what happens when the 30-year mortgage goes outside the range?
Oh, my goodness. I would argue we're there. I feel pretty smart with my 6% mortgage here. So, Mark, what do we do here in terms of risk? I mean, and as you talk to your clients here, how much risk do they want to take these days? Do they want to buy big tech equities? Do they just want to sit in the 2-year treasury at 4%? Do they want to take credit risk? Are they just sitting in gold?
No, I don't think they're just sitting in gold, although it's a good point. A lot of people do have that in there as one of the few diversifiers. And as Tom was saying, correlations are a big topic for our institutional clients. They're dynamic. They're not your grandfather's correlations. And so people are recalibrating what correlations are prudent, whether it's across the pond, whether it's across asset classes, even just rates and equity correlations is
so what's let's bring it back to mere mortals. They're like the 10-year real yield. Really, Tom, what does that number mean? What is it? How does all of this fixed income and currency angst fold into a belief in the equity market?
It folds into a very low confidence in the equity market. You have to be invested, but you also have to be prudent. So to Paul's question, staying close to your benchmark, perhaps going up a little bit in terms of quality and predictability. Don't try to pick the bottom with a company that's struggling. but rather go with bluer chips that you know are going to deliver or you have a high confidence. And the same thing for your fixed income portfolios. A little bit up in quality, a little bit up in structure, and certainly shorter in duration. People are very worried about long duration fixed income. And this goes back to the broader narrative, which is the combination of tightening labor markets due to immigration, greater inflation due to tariffs, and this global deglobalization. It's not just the U.S. Populism we saw over the weekend is growing in Europe. It's growing in other parts of the world. That is going to lead to more economic warfare between countries. That is not good for the structure of interest rates, and that's why you're seeing long duration assets delink from shorter duration. The other thing that's really important that came out of our conference yesterday was a clearer view of what's going to happen at the Fed next year. That there's going to be somebody new leading the Fed, and perhaps some other changes at the Fed as well, not just in the chairmanship. That combination also potentially means more stimulus of the monetary nature, which contributes to this steepening. And a worry, not a fear, but a worry that the Fed gets more politicized. And if that happens, you have the front end perhaps rallies more, but the back end delinks.
I'm looking at the INGO function on the Bloomberg terminal, the Bloomberg index browser. The best performance year to date in fixed income has been high yield. So the market's comfortable with taking credit risk. Are you guys?
We're comfortable with it, Paul. We don't love it at today's valuations. To your point earlier, we've had a snapback. We think the ructions in Washington are probably going to lead to something of a repricing and create a better entrance opportunity for U.S. high yield in the coming months, particularly as the seasonals of the summer slow down. But we're comfortable with the underlying fundamentals, but we just don't love the valuations.
Mark, thank you so much. Greatly appreciate it. The best part about it, it's May, and Mark Howard comes in, and he and Sweeney are screaming at each other about East Coast versus Colorado skiing.
Yes.
I mean,
he's a big-time Maine guy.
He's a Maine guy.
And those people are, those are unique folks up there. Hardy souls up there in Maine.
They are. I mean, he's been to LL Bean at 2 in the morning.
Yes.
Exactly. Mark Howard, thank you so much with BNP Paribas.